Hi, I'm Seth Freuberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So this week I'd like to share with you an interesting conversation I had with one of the traders on our desk. He will go unnamed, but let's just say he's from down under, and he's a great guy, very active in the options tribe and very active on our options trading desk, a great contributor to our desk. And this particular trader and I were in conducting a mentoring session, and he told me that on his own volition, he had decided to do a review of his trading over the past year, an annual review, which is a great idea and something we highly suggest here at SMB. In fact, the equity traders do a monthly review where they go over their goals and how they're achieving their goals. They take a look back and they take a look forward as well. And so this trader did this of his own volition. It's a really important practice. I've heard some of the great top traders say if you don't journal and you don't review your work, you might as well not trade because you're not going to grow. And so this trader takes all these processes seriously, and as a result, he is growing and he will grow. And so I'd like to share with you what he picked up from his annual review because I think the points are really good and very helpful and shows you that he is a seasoned options trader and understands the issues and was able to kind of course correct on his own, which is terrific. So the first thing he noticed when he looked back at his year was that he was not following his damn back tests. Now, I've talked about this before. If you're going to do a back test and then not follow it, don't bother doing it. If you're going to do a back test and you're all excited about the strategy because it gave you this terrific return, and you're expecting to get the Nobel Prize because you developed this new strategy with a great return, and then when you trade it live, you don't follow your back test, what's the point? And so what he realized was that his returns were adversely affected by not trading the way he had back-tested it. This is a very, very common problem that people have. I have it. Other people have it. I admit to having it myself. I admit to jumping in and using my wisdom in certain circumstances because I know what the market's going to do next. And I would say 8 times out of 10 I'm wrong, and the market does the exact opposite. And it was very foolish of me to have jumped the back test, so to speak. So he found, looking at things empirically, that he had in fact done worse by not following his back test. So it's a really important lesson. It's one thing to talk about it in theory. It's another thing to look back and say, wow, I really screwed myself up here by not following my back test. That's pretty important information. So that's number one. Number two was about entry pricing. And this is something we've really been focusing on our desk lately, which is the traders who tend to trade by being very aware of pricing and not jumping into a trade until the pricing's favorable. Those traders are the more successful traders on our desk. We have a process where traders submit a trading plan to me, and our traders are careful about following the plan. And so when they want to sort of jump in a little early on a month because they're seeing excellent pricing, on the same day I'll get emails or Skype messages or whatever from 2 or 3 of the traders saying, hey, I'm seeing some great pricing in December. I want to jump in early. You okay with that? And what that's telling me is that these people are watching the pricing and recognize when it has improved, and they're jumping in at the right time according to their experience. So waiting for good pricing is a really good idea. It takes patience. Sometimes it can take days. And sometimes it never happens. Sometimes the market just never gives you that pricing. In which case, what he realized is if you don't get the good pricing, then your mindset has to change. You give yourself a limit of time. If you don't get the positive pricing within that period of time, then, and let's say your limit's a week. If you don't get in within a week, then you get in anyway. But in this case, you reduce your projected profit, your target profit on the trade, proportionately by how much worse the pricing was upon entry than what you would have wanted. So the second takeaway that he got from his study of his own trading was patience in pricing really improves your returns. And I have seen this on our trading desk. I know this is real. Being impatient as to entry pricing is not a good idea and will reduce your turns over time. You'll probably do okay, but you won't do as well as you would have done if you had been patient about pricing. But having said that, you've got to wait. You've got to jump in at one point. You can't hesitate forever, and then the whole month goes by and you don't even get in. And what would have been a $10 butterfly turns into a $22 butterfly, for example, and I've seen that happen. And you don't want to enter at $22 when the appropriate price is 10. So that was his second takeaway. And the third takeaway is a little subtle, and experienced options traders will recognize this. There are certain days where suddenly, in a good month normally, your P&L will improve drastically. And it happens now and then. It often happens after some major event in the market has passed, the market is relieved that something bad didn't happen, and so a lot of volatility comes out. And in those cases, on those days, oftentimes there will be quite an improvement in the trade. When that happens, if you are close to target profit, that's the day you should take the trade off. What he found through looking at months, if he was not decisive on that day and instead tried to bleed out the very last penny up to profit target, sometimes he would greatly regret it, and it would turn out that the month ended up being a loser, or just not much of a winner compared to what it could have been. So from his observations, he found that on the days where the market suddenly gifts you a lot of profit and you are very close to your profit target, don't wait to get to exactly your profit target. It's a good idea to probably take your money and run on that day. So those were his three takeaways. Now, they all sound like common sense to me. You might be able to argue with one or two of them as to degree, or you may tweak them in some way. But this was his own review, and he is now determined to trade based upon his own observations of his own trading. And that's what's important. He's going through a self-improvement process based on the reality of his own trading, not theory. This is the way he really traded, and everything he said made sense, and it certainly made sense in the context of his trading. So please think about a periodic review process on your trading. You will improve if you're constantly assessing what you're doing and trying to improve it. You will improve. You'll get better over time. It takes a while to get good as a trader, just as it takes a while to be a good lawyer, doctor, car mechanic, golfer, whatever. It's going to take some time to get good, but if you don't have a self-correcting improvement process, you will not be elite in your profession, whatever that is, and our profession's trading. So thanks very much. Go through a self-improvement process. It can't hurt you. It can only do great things for your trading and can only be helpful. Thanks very much, and we'll see you next week.